Welcome back to the Contrarian, everybody. Today I'll be talking about the bond market. Are bonds a good buy right now historically? Obviously, I'm not giving personalized financial advice. I never can. I don't do that on this channel. But I will be talking about a recent article that Barron's just put out, really giving some perspective on the historical cheapness that bonds currently are right now, how it's very rare, just looking in the previous 100 years or more, for bonds to be as cheap as they are. Also looking at some recent action by Bill Ackman, a hedge fund owner, trader, definitely more prominent on social media as well. He has been short bonds up until recently, and then apparently he just went long bonds. We don't really know how much yet, but that does indicate maybe something changing there that he might know about, or uh, even regardless of if there's some sort of inside knowledge he has. Maybe it's just interesting to look at what he's done recently as well. But first, looking at an article that Barron's put out just a couple of days ago. It's funny because the picture on the cover is of flowers, which maybe reminds me of Tulip Mania, previous bubble that occurred. The title of their article is "It's Time to Stop Crying About Bonds and Buy Them Instead." Rarely in American history has it been this bad for bonds, and rarely has it been such an opportune time to buy. The bond rout has been brutal. Supposedly, ultra-safe treasuries are on track to lose money for 3 consecutive years, declining 42% over that period. Other bonds, whether mortgage-backed securities or high-quality corporates, have also taken a beating, leaving investors with losses from what are supposed to provide a ballast in a portfolio. So, what they're getting at first off is just in the last 2, 3 years, interest rates generally have gone from very low levels to historically more consistent levels, but compared to the last 3 decades, very elevated levels from where rates have been. So, the federal funds rate in particular was kept near 0% for a while. During Trump's presidency, Jerome Powell tried to normalize interest rates. It got up to maybe 2.7% before the market threw the tantrum in fall of 2018, and so they had to rapidly cut rates. Then, of course, they said that it wasn't because there was severe issues as a result of their tightening, but they kept rates very low. And then with COVID, they cut them to basically a 0% Fed funds rate. So throughout the prior 15 years, from 2008 to 2022 approximately, the Fed funds rate was between 0 and 2.5%, but usually around 0%. So very low level. During that time period, treasuries stayed fairly consistent in terms of their ability to just bolster a portfolio, because traditionally, when a recession would hit, the Fed would cut their rates, the Fed funds rate, and investors would go into bonds. And when investors would buy bonds, it would bid up the price and it would lower the rate. So, key to understanding a bond is it's like a teeter totter. When either the rate or the price fluctuates, going up, the other must go down. So, when investors bid up the price of bonds, whatever they are, mortgage bonds, treasury bonds, when they bid up the price, rates fall. When rates rise, that's an indication that prices of the bond itself are falling. So, it's an inverse relationship between those two factors, bond yields and bond prices. And in the last 2 or 3 years, bond yields have risen, which indicates a falling in bond prices, less investors willing to buy bonds. And this, of course, could be due to a variety of reasons, but maybe most notably so is the Fed's aggressive withdrawal of purchasing bonds, whatever they might be, the Fed wanting to have less of an influence on the market, and then in fact going into QT, or net selling of treasury bonds. When the Fed does that, they're actually putting more supply of bonds on the market for investors or groups or whoever would typically buy them. There's suddenly there's a greater amount of supply of bonds on the market, than there otherwise would be. And so it's probably largely due to the rate hikes and the Fed tightening program that has led to the rout that we've seen in bonds. And in fact, it's very unique for bonds to have suffered this much, and for the stock market to still be, 10% from all-time highs. Looking at most market indices, it really, I'm having a hard time thinking of when that has existed in the past, because um, usually the bond market is much more stable to begin with, but also usually when that is down so much, you would typically think that the stock market would also be down dramatically as well. But so far, that's not really the case. Um, but going on further in their article, they say, consider what may come next, the end of the bond bear market. While long term yields have spiked lately, pushing the 10-year Treasury to 4.9% from 4% in August, the Federal Reserve may be nearing the end of its campaign of interest rate increases. Traders see only a 25% chance of another rate hike this year, possibly at the Fed's meeting in December. And then they mentioned Bill Ackman, a prominent bond bear, recently closed out his bets against treasuries. And Bill Ackman, in particular, may be an interesting character to look at because he does like to exert maybe some of his influence on the market in terms of influencing investors when he can, oftentimes to his own benefit. So, for example, looking in the March April 2020 era, it later came out that Bill Ackman actually went short a lot of the leisure and travel related stocks that were pummeled during that time. But he went short, and then he actually went on Bloomberg, CNBC, and basically talked down the stock market, saying like, "Oh, the COVID virus is going to shut everything down. It's going to, potentially destroy a lot of businesses." So he was out there exerting influence on investors, basically saying that they should, um, sell some of these stocks. Or I don't know if he said it exactly, but he was trying to influence sentiment. And so, it's kind of interesting to then see him do the same thing with bonds, taking a short position on bonds, talking them down on his Twitter account. I don't know if he appeared on any mainstream news as well as doing that, but then now to see him covering his short and also talking about that, he might know that something is afoot with regards to a Fed change policy, something like that. I will point out that just looking at investor sentiment in the bond market right now, there's a lot of people out there calling for much higher rates even than where they currently are on the longer term treasuries, things like that. Um, you know, I'm I tend to be of the opinion that that's probably an indication that we're close to capitulation in the bond market when so many people are skeptical of of this being the bottom when they're calling for lower prices. It does kind of make me reminisce of prior bottoms that we've seen in markets, but it is hard to call bottoms exactly. Bill Ackman appears to think that this is close to the bottom, and he's covered his short position that he had on bonds. But a lot of this could depend too on, does the Fed begin to step back in and purchase bonds, or do less QT that they were saying that they would do? Do they have to reverse course? Because at the end of the day, the Fed has the power to back these treasury auctions that are going on. If Janet Yellen starts seeing a lot of things going awry, and these treasury auctions are not going as well as she would hope, or as they should be going, she could definitely call up Jerome Powell and say, "Hey, you need to back the treasury market. I don't really care what kind of narrative you have to spin to do it, but things are starting to go awry here." At the end of the day, the Fed can do that. Yes, it would be prior to when they were saying that they would be doing that again, but they are experts on being way behind the curve, like they were with trying to fight inflation to begin with, um, which is a whole different topic in and of itself. But it's interesting to look at the fact that there's so much of a lead and lag to their policy that so much of the tightening that they've already done may have actually not even impacted the economy yet, just due to the anywhere from 12 to 24 month lag that has. If it's a 12-month lag, then about half of the Fed's tightening has actually been felt yet on the economy. If it's 2 years, then none of their tightening has been affected the economy yet. So, the Fed really is behind the curve, unfortunately, a lot of the time, just due to how lagging of an effect their policies can have. But mainly looking at the bond market right now, how much of a sell off it's had even in recent weeks, how this has impacted sentiment so dramatically, does lead me to think that probably close to bottom in the bond market, referring to prices. Therefore, I'm saying that yields are probably topping out pretty close to here. I know there's going to be a lot of people who disagree with me there. Peter Schiff, for example, he's calling for rates to go much higher. He's saying that the Fed has lost control of the treasury market, of treasury rates. Um, maybe they have, maybe I'm completely wrong, but I do think at the end of the day, they have the ability to print money basically as much as they need to back that market. And I think if they did that, I think a lot of people would suddenly get back in and start buying bonds again. But all this being said, I'd like to hear what all of you think about this in the comment section below. Bonds, is this a terrible time to get into them? Are they just going to keep going downhill from here? Is this the end of the dollar as the reserve currency? Is this the end of the treasury market being seen as the gold standard for a portfolio? Or is this an opportune time to get in? I'd like to hear all of your thoughts about this in the comment section below. I hope to see all of you again at some point.